continues to be testing. We continue to be optimistic though. I'm saying this for two reasons. One is the sheer potential of the areas that we operate in is so enormous that we do believe over a long period of time there's going to be considerable opportunity for the company to pursue profitable growth. The second reason why I'm saying this is the macros which dominate the country's economic landscape are possibly in very good shape. We have highly manageable fiscal and current account deficits. We have reined in as an economy inflation. The interest rate environment has been benign. There's a lot of expectation on the monetary policy authorities to support growth. We've had a fairly good monsoon so far. We've had broad basing of tax collections, if you go by the number of additional returns that have got filed. So I think as a country and as an economy, there are a lot of things that are aligned well. And it is up to corporates like us to take advantage of this opportunity to move forward. Obviously, there are challenges, and I think it's very important to recognize them as well as we plan for profitable growth. We have investment momentum, which is still lackluster. The spends are led by public sector and government. The programs are largely state-sponsored. We do have non-performing assets as a major issue to be tackled in the banking sectors, which have assisted the capital formation in the past. We thankfully have a very robust capital market driven by liquidity, but we also need to have a very robust and quick dispute resolution mechanism for us to be able to operate meaningfully in the current space. So having said this, let me get to presenting the performance of the company for the quarter one. The usual disclaimer on forward-looking statements that could be made in the course of this presentation. The highlights are bucketed into four broad categories. We do report a degrowth in order inflow of 11%, and this is largely on account of a large order win that we had in quarter one of the previous year. We'll look into details a few slides down. Order book at 2.63 trillion is up 2% as compared to the order book that was there in the same period last year. Revenue is up at 10%. EBITDA has grown by 9%, and profit after tax is up by 46%. And considering the environment that we briefly spoke about, I think these numbers augur well for the rest of the year. Looking at the financial results, and in particular looking at the order inflow, which is a matter of great importance to the company and to the markets, we have won orders worth 264 billion rupees in the first quarter, which is actually 10% higher than what we thought we will end the quarter with. We've been fortunate that we've had the roll of the die in terms of some of the orders coming in a little ahead than what they were originally planned. Nevertheless, they are 11% lower than the order wins that we had in quarter one of the previous year. And this is largely on account of 6,500 crore orders that we won in hydrocarbon space last year this time. And when you have such a lumpy order in any quarter, the quarter-to-quarter comparison does become challenging going forward. But the important aspect of this growth is domestic orders have grown in excess of the international orders. During the quarter that I'm reporting, we had 12% growth in domestic orders, and the international orders grew by 8.5-9%. So overall, we do see the first signs, so to speak, of some of the sectors in the domestic economy picking up pace. We had infrastructure pulling its weight, and largely in terms of power transmission, distribution, area of water, and even in space of minerals, metals, which have been considerably strained in the past quarters. We have had some turnaround in terms of some of the refineries beginning to look at their capital expenditure. We also have an order book consequent to these order wins at 2,62,000 crore or 2.62 trillion rupees. And we do find that almost close to 2 lakh crore is on account of domestic orders. and 684 billion on international orders. Another point to note is 70% of the orders that we have won during Q1 is domestic orders, and the international accounts for 30%. When it comes to order book, we have close to 26% of the order book to be executed on contracts on the international markets. Looking at where the orders came for the company during Q1, we had 57% of the order flow coming in from infrastructure segment. And as you know, this segment does cover areas like transportation infrastructure, heavy civil, buildings and factories, power transmission distribution, water effluent treatment, and smart cities. We have very little order wins during this quarter in the area of power, in the area of heavy engineering, and hydrocarbon. We did see services part of our portfolio doing well, and as we normally report, the revenues of the services constitute the order inflow as well. So we have 21% of the order inflow contributed by the services sectors, and the balance 10% is the residuary business that we have. If you look at the order book breakdown, we have close to 2 lakh crore from the space of infrastructure. So out of the 2,62,000 crores, 75% is in the area of infrastructure, which anyway is the area where the government-sponsored programs are focused on. So consequently, it is no surprise that much of our order wins as well as order book lies in the infrastructure space. Hydrocarbon has moved up to 230 billion rupees in terms of order book, followed by power and heavy engineering at 123 and 120 billion rupees. All the rest of the business put together has close to 150 billion rupees of orders to be executed. Looking at the financial performance of the company for the quarter, we are reporting revenues of 239 billion rupees, which is 9.7% growth over the 218 billion that we reported in Q1 of the previous year. The manufacturing and the construction expenses are keeping pace with the progress that we are achieving on the jobs under execution, and hence the increase of 12.2% for the quarter ended June 18 has to be seen in the context of the progress that we are achieving on the jobs. Finance charges have moved up from 13.3 billion to 13.9 billion, and the staff costs have been contained at 35.3 billion as compared to 34.2 billion of the first quarter of the previous year. Much of the staff cost containment is on account of the productivity improvement focus and the resource reorganization that the company is engaged in to deal with this continued slowdown in the investment environment. Sales administration expenses is up 7.3% at 16.9 billion rupees. This is largely on account of the provisioning that we are making for credit in financial services business. And we are, as you would have possibly noticed and heard commentaries on the financial services business, which when reported their results, that both combination of prudential norms as well as an assessment of the portfolio has caused the increase in the credit cost. Just to make a point, notwithstanding the increase in the provisioning, the profit growth of the financial services business has been an impressive 49%. So the total operating expenditure of the group is at 219 billion rupees, up 9.7%, almost in tandem with the growth in revenue. And consequently, the EBITDA EBITDA margin at 8.6% stays flat. The EBITDA, however, at 20.6 billion is up 8.9%. The finance cost at 3.7 billion rupees is higher by 12% as compared to 3.2 billion. Combination of both customer advances, which are interest bearing, as well as mix of borrowing tending more towards short-term borrowing, given that there is an anticipation of softening of interest rate, has led to an increase in the interest cost. But the cost of funds still remains very competitive at a group consolidated level at 7.7%. The depreciation at 5.5 billion rupees is up 18%. This is largely on account of an asset that we impaired in Middle East when we were rebalancing our capacity in Middle East between the various businesses, namely hydrocarbon and heavy engineering business. Other income at 3.8 billion rupees represents the treasury earnings that the company has made, and it is 25% higher than the 3.1 billion of the previous year. Profit after tax before exceptional item, and there are no exceptional items in the quarter under reporting. Profit after tax at 8.9 billion rupees is up 46% as compared to 6.1 billion rupees, largely on account of improved performances of some of the subsidiary associate companies. The reported profit after tax stays at 8.9 because of no exceptional income embedded in the charts. The segment performance, we are divided into the broad infrastructure, power, heavy engineering, electrical, hydrocarbon, developmental projects, information technology, technology services, financial services, and others. And this is broad segmentation that we normally report, and there are no change in that reporting. Looking at a couple of segments, a slide, we start with infrastructure segment. This segment has had a very good first quarter. At 105 billion rupees of revenue, the revenues are up at 16%. This is in the context of overall revenue growing by 10%. But normally, given the dominant segment that infrastructure is, infrastructure segment, if it pulls ahead on these lines, it augurs well for the overall revenue of the company. Of the 105 billion, 34.2 billion represents the earnings that we have from the contracts in the infrastructure space that we execute outside of India. The EBITDA margins at 8.1% is lower than the 9.2 of quarter one of the first year, but not a cause of concern because our project progress is not linear. So the quarterly volatility in the revenue and the profits and hence the margins are to be expected. We do stick to our earlier assessment that we would end the year in terms of all our margins, excluding the services business and the developmental project business, hopefully at 25 basis points higher than what we reported for the full year last year. Power segment, as all of us know, is facing a lot of headwinds at the sectorial level. There are several issues in terms of excess capacity, very competitive, aggressive bids that are coming in, limited opportunities, and so on and so forth. There are several capacities which are half-built, waiting to be completed. There are non-performing assets issues that needs to be resolved. There are PPAs which are getting renegotiated, and the fuel supplies which are getting realigned. So considering the amount of issues that are getting dealt with this sector, it is of no surprise that we've had a very flat year in terms of power operations. The revenue for the quarter is at 17.6 billion rupees, which is more or less a 2% growth over the 17.2 billion of the previous year. The EBITDA margins at 1.3% is representative of both the capacity underutilization and the competitive pressures that sweep this sector. Hydrocarbon sector has turned around well. We have in the past discussed about projects in the Middle East which have not performed well. Happy to report that all of those projects have been resolved, and we are now looking at numbers which emanate out of projects under execution, and they are all in good health. The segment revenue from hydrocarbon at 25 billion rupees is up 18.7%. As you can see, more than half of that revenue comes from international jobs. EBITDA margins at 6.8 reflect the growing volume as well as a departure from the loss-making legacy jobs and entry into profitable portfolio of jobs. Heavy engineering segment has had a difficult quarter. Even though the investment momentum in the downstream segment looks better than the upstream segment, the order for custom-built equipments will take some time to come, so we still are experiencing headwinds in terms of ordering opportunities. The revenue at 6.1 billion is down 7% as compared to the revenue of the corresponding quarter previous year. The margins are up at 15.9% and largely representing the state of completion of the jobs under execution. And like in the case of project business, there will be quarterly volatility even in the equipment business. Electrical automation has had a good turnaround in this quarter. We do not know whether thanks are due essentially to GST, but there has been a lot of movement in terms of inventory liquidation. So consequently, we find that at 11.3 billion rupees, the segmental revenue grew by 21% in this quarter. I must hasten to add that the July-September quarter, which is actually going to be the litmus test for the GST transition, we need to wait and watch as to how far the supply chain and the distribution network responds to the new GST environment. and how far they are able to sustain the momentum on the volume growth. But we do believe if the country does recover to do better in the subsequent quarters, that GST readjustment could be a transitionary period and that we could get back to more serious end of growth when it comes to the subsequent quarters. We do hope in the interest of the industry that this realignment to the new taxation structure settles down early.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.